Hi, guys. Hope you're well. Let's go over the big news, at least the big news for me, I think. It's the non-farm payroll. And whoa, I am giant. What has happened? Sebastian told me how to make the font bigger, but unfortunately, I'm bigger as well. Let me get my giant head out of the way here. It's almost like I'm the exact same as my thumbnails in real life. You guys didn't know that. I'm a bobblehead in real life. My head is twice the size of my entire body. All right, I think we got it figured out here. Let's dive into the data. The U.S. economy cut 140,000 jobs in December, well below market expectations of a 71,000 job increase. It is the first drop in employment since the job market started to recover in May from a record 20 million job loss in April. Employment declines now this is what I want you guys to pay specific attention to. First and foremost, we had 140,000 job loss in December, and we're going to get to the chart. You can see how much we'll kind of put that into context. But here's, I think, maybe even the bigger part right here. Employment declines in leisure and hospitality, private education, government. And those were partially offset by gains in business services, retail trade, construction, transportation, and warehousing. Okay, got it. I want you guys to look at the types of jobs they just outlined and ask yourself one question. Who's making all the stuff? Like this leisure and hospitality? Okay, well, they're not making any stuff. Private education? Nope. Government? Definitely not. Business services, retail, construction, transportation, warehousing? No. No one's making any goods. All we're doing is creating this economy, which I've said in several of my videos, which is just based on domestic services. It's just plumbers and electricians and accountants and lawyers and teachers. And it's not like those are bad jobs, but okay, let's just say that you lived on a deserted island. We'll go back to that. And there was a barista, there was a bartender, there was an electrician, and an Uber driver. Fantastic. But how do you clothe yourself? How do you put food on the table? How do you get stuff? They can't do their jobs really without any of the stuff that we don't create in our economy. So I'll get off that tangent, but I think that's something we really need to start thinking about. Is not only, I mean, we talked about the structural flaws of the economy and the stimulus and the artificially low interest rates, malinvestment, all of those things, misallocation of resources. But what I think we fail to recognize, and we talk about the trade deficit, but at the end of the day, I think we kind of gloss over the fact that this economy just revolves around domestic services. And there's nothing sustainable in that. We're just trading these services back and forth to one another, paying each other for them, and then just assuming that all of the stuff we need to live is just going to be produced by someone else. That is a dangerous, dangerous game. Anyway, let's get to the chart. So prior to the cerveza sickness, we were adding about 200,000 jobs per month. And then it hit down 1 million, down 20 million. And then we had this quote unquote jobs recovery, which I don't think it's a recovery. I don't think you're really adding jobs. You're just kind of getting back some of the massive amount of jobs that were lost. 2 million, 5 million roughly, 1.7, 1.4. And then you see it gradually trend down. And that goes back to my whiteboard video that actually is up this evening, where we look at initial jobless claims and continued jobless claims. But the economists thought that it would just gradually trend down. Sure, we've gone into some lockdowns, but so many more businesses are open up. People are going back to work. Don't think so. 140,000 job loss. This is the first loss we've had since April. So, and the economists are saying, okay, well, this is because of more lockdowns. It's because of a second wave. Okay. I would more so argue because what was the stat that we saw the other day? 60 or it was either 40 or 60% of the businesses that closed because of the cerveza sickness are never coming back. They're gone. So yeah, I would argue there's something in there regarding, or there's a cross current in there because of the lockdowns and second wave here. But I would argue it's more so a factor of the economy is fundamentally flawed. And now moving forward, we only have, let's just say 70% or 80% of the small and mid-sized businesses that we had back in January. And that dog don't hunt. You say, well, that's just down 20%. Yeah, let's go back to my interview with Jim Bianco. If you guys didn't hear that, the GDP of the United States that gave us the GFC, that catastrophe, the second worst financial crisis or recession, depression since the Great Depression in the 1930s, that was because GDP fell by 6%. It went from 100%, the economy, the output, down to 94%. So longer term, what happens to the economy if there's no stimulus and the heroin addict has to stand on their own 2 feet? If we only have 80% of the businesses that we had back here in January, that means GDP, let's say, is down 10%, 15%. Okay, great. Well, that gives us something twice as bad as the GFC. And that's from a structural standpoint. You see, that's not just, oh, well, we fired you or we laid you off, and 2 weeks from now, we're going to go ahead and hire you back. No, the businesses don't exist anymore to hire anyone else back. They're gone. The only way that we can create those jobs in the future is if we create new businesses. And with the regulatory environment, with the taxes most likely going through the roof, good luck starting enough businesses to get us to where we were, or even get us to a point where we have positive real GDP without the help of stimulus and government deficit spending, which you say, okay, well, that's fine. They'll just deficit spend. Now, you got to remember, every dollar, excuse me, every dollar that's spent by the government is distorting the economy that we otherwise would have with free market capitalism. So the more you distort the economy, the worse it gets, regardless of how much you want to paper over it with Stimmys and deficit spending. So let's move on. Story from CNBC, S&P, right? So we just went through the jobs numbers. They're a catastrophe, but in my opinion, expected. I don't know why we should have expected anything else. But what happens with the stock market? So real economy disintegrating, but S&P 500 rises. Heads for a winning week despite disappointing jobs report and Washington turmoil. S&P 500 Nasdaq Composite rose to record highs on Friday, even after the release of data showing the U.S. economy unexpectedly lost jobs last month. Those gains put the market benchmark on track to end the first trading week of 2021 on a high note. So you're just scratching your head saying, okay, the economy is in crisis mode and the stock market is going to all-time highs. I thought the stock market was supposed to be a reflection of the economy because it represents businesses and their profits that actually depend on the real economy. I don't think so. Remember what I've been saying in my videos, that I believe there's actually an inverse correlation now between the real economy and the stock market, meaning the worse the real economy gets, the better the stock market does. Unfortunately, it seems like that's playing out. And here, Adam Crisafulli, founder of Vital Knowledge, wrote, weaker than expected print raises the possibility of more government aid from President-elect Joe Biden. Let's go ahead and replace more government aid with more economic distortions, with more distortions of our economy. Biden's team was already going to be pushing for increased distortions of the economy, and the December report provides them with even more ammunition to make their case. Fantastic. Friday's move comes after a record-setting session. The Dow closed above 31,000. Okay, we already went over that. So you see what's happening is the stock market is going up in hopes that the government destroys the economy further, misallocates more resources, creates more malinvestment, creates a bigger, let's call it financial bubble, through more deficit spending and more Stimmys. Like, that's something to get excited about. We're getting excited about the heroin addict receiving larger doses of heroin. That's the bottom line. And I want to point out a chart I saw. I'm right in the middle of it here. All right, this chart. So this is a chart of Tesla. And I always kind of give them a hard time. They're kind of the poster boy for this market, in my opinion. And I'm not here to say they've got bad cars. I think the cars are pretty cool, actually. And I'm not here to throw Elon Musk under the bus or anything like that. I mean, I don't want to even get into that debate. And I don't even want to say that, Tesla's not a legit company. I mean, they made some profits. I actually looked at their financial statement prior to doing this, and they made almost $1 billion in the trailing 12 months. Now, is from what I saw, and I could be reading it incorrectly, but I mean, is that a result of selling cars? Or is that a result of something else? Is that a result of WeWork type accounting? I tried to dig into their top line number, and it really didn't give me information as to what percentage of that top line was a result of selling cars or selling tax credits, or who knows. So anyway, but the bottom line is this chart, I think, really goes back to what we're saying, or what was outlined in the CNBC article we just went over. So 5 day. Yeah. Okay. So we go back 5 days and we see it pretty flat, kind of going down, flat pretty much. But then what happened starting yesterday? Well, people started receiving their stimulus checks, the Stimmys. They went on TikTok. They got FOMO. They further went down that rabbit hole in their echo chamber, that mental rabbit hole, seeing themselves as, or seeing their future, the only way that they can get rich, the only way that they can create purchasing power, the only way that they can better their outlook for their future, I think that's what I'm trying to say, is by buying assets. And so what do? They go in and as human beings, we have recency bias. And I find myself doing this all the time. But fortunately, I've read so many books and I've studied the legends so much that I can catch myself. Like whatever has happened over the past 3 months, think about it. You just feel like it's going to continue to happen forever. So we look at stocks like Tesla, like this chart that is just basically going vertical here. Let's pull up a 2-year. See, and you see this from this or to this, and it's hard for human beings not to think or feel, because it's like a feeling that it's just going to do this indefinitely. And it's like when you see a chart like this, or when you've experienced this price move, it's hard to even imagine the price is actually going down. And it's even harder for a retail investor or someone who's never lived through a bubble bursting to kind of check themselves, look themselves in the mirror and say, wait a minute, time out. You're being too much of a human right now. You need to be more of a robot. And a robot would just be completely data driven and would not worry about, or would not even consider the fact that the stock has doubled in the last month. So going back to this 5-day chart, I think everyone gets their Stimmys, maybe call it 2-3 days ago. And sure enough, what happens to Tesla? It just goes straight up. And now, of course, this is just anecdotal. I don't have any thing that would show me definitively that Tesla is going up as a result of people starting to get this next round of their stimulus checks. But this article shows us while the IRS has reportedly already made 2/3 of the current stimulus payments via direct deposit to bank accounts. Okay, and this came out today. So obviously, correlation isn't causation, but there's definitely a correlation in the timing of people getting their stimulus checks and Tesla moving up on its most recent parabolic rise. So that's what I wanted to go over today and really get you thinking about. Oh, and there's one other thing too. I forgot about that. Bear with me, guys. In this, and I don't know where I disappeared to, but it doesn't matter. I'll figure that out later. I wanted to point out this right here. Elon Musk is now the richest person in the world. And again, more power to him. But if we think through how this has happened recently, and if you believe the retail investors are, through this FOMO and social media and these echo chambers, are taking their Stimmys and going into Tesla, which would make sense when you see that TikTok video that I outlined in my whiteboard the other day. If you believe that that's happening, then the government is, or the Fed starts there, is monetizing the government debt. They're creating bank reserves out of thin air to buy treasuries. Those treasuries, the bank reserves that the Treasury gets, is used to back up all of the Stimmys that go out to the individuals. That process is distorting our economy, like I've said many times in this video. It's creating malinvestment, a misallocation of resources, which at some point in time, we as a society are going to have to pay for. Okay, so what's happening here is we're destroying our economy, the fundamentals, long term, and the unintended consequence is that all of the new money printing, if you want to call it that, is just going into Elon Musk's back pocket. So we're printing all this money. We're destroying the fundamentals of our economy just to make Elon Musk the richest person in the world. Go ahead and think about that. And that's where I'll end it. We'll see you in the next video.